Awesome. Well, the next question builds on the last one, and it's about changing your portfolio as you age. And it's from Mary on Instagram. And she said, I know according to our age, we should be using different strategies to invest. Younger people should potentially be using higher growth strategies because they have more time to invest. So if I build a high growth portfolio when I'm in my 30s, if I add another 30 years onto that, how should I then change my portfolio from high growth to potentially more defensive when I'm closer to retirement?
Cool. Great question. So let's say I'm going to just do an example. This is not based on Mary's situation because we don't actually know what that is. But let's say we have an example. You are 35 today and you want to retire at 65. So that's exactly 30 years. You have $50,000 in your investing portfolio and you invest all of that into the share market. You achieve a 6% return after fees and that, and you invest $1,000 a month. So 6%, you add $1,000 a month, and you've got $50,000 to start with. In 30 years, you will have $1.2 million. Now let's run that same scenario, and you've got a 3% return because that's the bonds, and you put $500 in a month. So imagine this would be an example of you have $1,500 to invest in your investing account every month. But instead of putting it all in shares, you put $500 into bonds, and you've got the $1,000 into shares. But because bonds are more defensive, you make less of a return. Now, if I assume that you still start with $50,000 in this account, so you would have $100,000 today, $50,000 in shares, $50,000 in bonds, but we said we're putting less into bonds. The bond side of your portfolio would only be worth $406,000. So that $50,000 would grow to $406,000. But on the share side, we know it's $1.2 million. So by the time you reach 65, your portfolio in percentage terms is what we would say out of balance. Now, the important points here are one, that if you have $1.2 million in shares and $400,000 in bonds by the time you hit 65, that's great. You might be out of balance in percentage terms, but don't overthink it. You've still got $1.6 million. So you're still doing very well. The important part of bonds is to minimize that volatility in the shorter term. So when you get closer to retirement, that's when you can start thinking about options. And your options might be, do I sell some of my shares and put that money into bonds? Or 10 years out, do I start putting more money into super, which I know is more balanced for me? Or do I just add all of my investment money into the bond side of my portfolio to boost that coming into retirement? But the important thing is that when you sell an investment, you will pay tax. So if you sell the shares part of your portfolio, you will pay tax. So you want to minimize the amount of selling that you do. That's just good investing. Minimize that side. And Kate, I've said to you before, the big important thing that people probably aren't considering, and I think I did a video of this into the Facebook group as well. One of the big things is that if you are investing in ETFs or managed funds, or even your super fund, pick the funds and the fund managers that are more likely to drop fees, not increase them. Some fund managers like Vanguard have shown that they will lower fees, and they're a big global like BlackRock and Spider and all them. They'll have low fees to begin with, and they just keep them low. So the important point is that if you have $1,000 and you invest in Vanguard or this one or that one, and you think, the fees are only a little bit different, like what's 0.5%? Today, that's not a big deal because you've only got a few $1,000s. But in 30 years, you might have $1 million, and all of a sudden you're thinking, oh my God, that other ETF, which I should have invested in, is now so much cheaper. I'm paying all of these fees. So what you should be considering is today, which for these fund managers are low cost and are going to stay low cost into the future. And that's a really important consideration because those fees that you pay could end up hurting you down the line. And I think, most of the big ETF providers are lowering fees, but Vanguard's one that tends to keep lowering fees. So keep that in mind too. So to answer Mary's question, don't overthink it would be the kind of the general gist of it. Don't overthink it. And Cassie's question too, don't overthink it too much. Just invest in really good things for the long term. And I don't know if you have anything to say on this one.
Yeah. And I just think you don't have to have it all figured out. I don't know what I'm going to do with my portfolio in 30 years, but I'm investing in a way that suits me for the next 10 or 20 years. So when it becomes closer to retirement, this might be the time when you've got a significantly larger balance where you go and talk to a financial advisor and come up with the right strategy that you're comfortable with, especially when you don't have an income source anymore. And I think that's, I don't think you have to have it all figured out in your 20s, 30s, or 40s. As long as you keep plugging away, you're investing on a regular basis, you've got low cost super and ETFs, and if you are investing in shares, you're putting in the work there. I think, I'm fairly aggressive in the way I invest at the moment, and then maybe when I get into my 50s or 60s, I might think more about adding some more defensive assets on top of what I already have in my ETF portfolio and my super fund.
Yep, I think that's great. Like you said, there's a great time to get advice is like 5 or 10 years out from retirement. And it's at that time when you can start to think, okay, how has my risk profile changed? How have I, invested up until now? What do I want to change? But in your 30s, you can afford to be more aggressive. Most people can be, not everyone, but most people can be, particularly if you've been investing for a while and you're familiar with things. And then, remember, as long as you're investing for the long term, and you can mentally and, with your behavior ride out the bumps, you put yourself in good stead for long term. We'll dive into more of these conversations around portfolio management and around bonds in the new year.